Hi friends, this is an extremely important video because in this video I'm going to speak about the sector rotation, because right now what is happening is that money is flowing into pharma, FMCG and IT sector. Let me back this up with some data. Have a look at my screen and you will see that Nifty IT index in the last 1 month has gained almost 7.5%. If you look at the Nifty healthcare index, you will see that in the last 1 month it has gained around 4.35%. And if you look at the Nifty FMCG index, you will note that in the last 1 month it has gone up by around 4.73%. An index moving by 5 to 8% in a month's time is a huge movement. Stocks is a different story, but when an index moves by 5 to 8% within a month's time, it tells you that there is money going into that particular sector. Now, if I also talk about the PSU theme, right now what is happening, have a look at this ETF. It is down by almost 5.33% in the last 1 month. So we can clearly see that there is a sector rotation happening right now where the investors are moving their money out of the PSU theme and have started to take positions in IT, pharma and FMCG space. Also, the second data point that you will see, this is the data that is about foreign investments in India. What foreigners are doing right now in India is that, have a look at this data for month of August. The 4 weeks of month of August, you will see FMCG, there has been net buying by FIIs. You can see the data here. You can see the healthcare, massive buying by FIIs. Look at the IT, first 2 weeks there was a selling, maybe because of the US recession fears, but in the last 2 weeks of August there has been a massive buying. And if you look at the financial sector here, there has been a massive selling by FIIs in the first 2 weeks of August. So banks and BFC have been under pressure. So the point I'm trying to drive home is that the FMCG, IT and pharma sector in the last 1 month has seen some positive movement, and if we understand this sector rotation, we can try to book profits maybe from the PSU sectors and try to take positions in the IT, healthcare and pharma sector. The first sector that I'm going to pick up is FMCG sector, and don't worry, I'm not going to analyze Hindustan Unilever Limited because already in the last 6 months HUL has given a rally of 22%, and in the context of FMCG stocks, 22% rally in the 6 months time is a very good run up already. In fact, I sold HUL just few days back. Coming back to Britannia Industries Limited, for example, again last 6 months 24% rally already has happened here. As I said, the people have started buying these FMCG stocks in the last few weeks and months, and potentially it is the last chance for us to do some buying in these particular sectors. Also, another example, Asian Paints, last 6 months rally has been around 16%. Of course, Asian Paints is not a stock, that is waiting for rural recovery to happen. But coming back to the stock that I want to discuss, a stock named Hindustan Foods Limited. Many of you may not even have heard about this particular stock. Last 6 months this stock has also gained 16%. But if I talk about the PE ratio of this company, you will see that it is trading at a 68 PE, and you will immediately say to me, Rahul, why are we even talking about a stock that is trading at a 68 PE versus the industry PE of 39? Because of the PEG ratio. Have a look at my screen and you will see the PEG ratio of this stock is lowest at 1.34 if you exclude LT Foods, which is anyways a rice exporting stock, a very different ball game altogether. But what is PEG ratio? If you're not clear, please request you to get your fundamentals and basics right. What is a PEG ratio? Let me give you 10 seconds commentary, and why is it extremely important when you're looking at valuations. So PEG ratio is the PE ratio divided by the EPS growth, right? Now tell me, if Hindustan Foods PE is at 68 but it is offering you a growth of 40%, let's say another company LT Foods, for the sake of discussion, 23 PE but maybe offering you only 10% EPS growth, which one investors are likely to go with? Because the growth of Hindustan Foods Limited is very high, that means the PEG ratio is on the lower side, PE ratio takes the back seat here, right? And also I will talk about the median PE, median PB of this stock so that you get more details. Just do not discard a stock just because the PE is very high. Let's understand a bit more about that particular stock. Now, if I talk about the fundamentals of Hindustan Foods Limited, you will very quickly notice the growth here. If you look at the top line, it has been growing at a phenomenal rate when it comes to the FMCG context. Last 3 years growth has been 25%. Last 3 years profit growth has been around 36%. If you compare HUL, if you compare Britannia Food Limited, their top line growth has been in single digits, 5 to 6%, not more than that. Here is a company that is growing at a CAGR of around 25% from a top line perspective, and from a profit perspective 36%. More importantly, if you see their businesses, you will see that FMCG is their core business, but more importantly, shoe manufacturing is what I want to draw your attention towards. There is a massive tailwind in the shoes manufacturing right now because of the BIS standards. And this is not just about the shoe manufacturing. If you see my screen here, the company has been putting lot of capex into various business streams in the last 4 to 6 quarters. So for example, they have built a juice production factory. They have been enhancing their ice cream plant by investing around 150 crores. Again, go ahead and please read this and you will understand the lot of capex injection that is going on into multiple business streams that the company is operating in. And I won't be surprised that in FY25 the company might go to the 4,000 crores of revenues. That is what has been talked about. If you look at the shareholding pattern very quickly, you will see that the mutual funds already have done the enough buying from 7.8% to 13.43% in the June quarter. Promoter stake seems to be very stable at 63%, so that leaves very limited float in the market. Now coming back to the high PE concern, that very quickly, if you see last 5 years, the median PE of this stock has been 86. Right now the stock is trading at around 67, well below the median PE. If I talk about the price to book ratio in terms of median value, has been around 16 in the last 5 years. Right now it has come down to around 10.2. So the company has been enjoying very high PE and very high PB in the past as well. It's not something very new. Moving on to stock number 2, which is from pharma sector. Pharma sector is full of very good stocks right now with their own strength and weaknesses. So it's very hard to pick any one stock, but I'm going to analyze Dr. Reddy's Laboratory in this video. Now coming back to Dr. Reddy's Laboratories Limited, if you see my screen, in the last 5 years, the stock has compounded at around 20% CAGR. So don't expect this stock to be a multi-bagger stock. Stocks like these are good stocks for stability in the portfolio. Again, I'm not saying that go and buy Dr. Reddy's Laboratory, but these stocks generally move at a steady rate, giving you 15 to 18% of CAGR compounding opportunity. Now, why I picked up Dr. Reddy's Laboratory for this discussion mainly is because of the highly attractive valuation, and one more reason that I'll speak about eventually in the next 2 to 3 minutes of time. But have a look at the valuation. You will find that PE ratio of Dr. Reddy's Laboratory is the lowest among companies like Cipla, Sun Pharma, etc. Also from a PB ratio perspective, it is looking well below the industry level at 3.95. But more importantly, if you look at the PEG ratio of this company, it is lowest at 0.82, because the EPS growth of the company is very high and the PE ratio is lower, giving the overall lower PEG ratio. Lower the PEG ratio, better it is, and that's why I picked up Dr. Reddy's Laboratory for this particular discussion. If you see the last few years, the company has been consistently adding around 2,000 to 3,000 crores of top line every single year. You can see that here. From a net profit perspective, in fact, more impressive. Last 3 years CAGR perspective, 41% growth, while the top line has grown by around 14% CAGR. The second hypercritical point about Dr. Reddy's Laboratory is their net cash position. Have a look at my screen and you will see that they're sitting at almost $808 million of net cash surplus, almost touching $1 billion. It's a huge money, and this is what is a competitive advantage of Dr. Reddy's Laboratory versus many other pharma companies, because if you have good cash with you, what you can do is spend some of that money into R&D. That's what typically pharma companies will do. If you go and look at pharma companies' R&D spending, you will see that anywhere between 10 to 15% of their annual revenues they end up spending just in the R&D, because they're constantly looking for new drugs to come and hit the market. Now, what are they going to do with this particular cash? The first obvious question may be that, Rahul, they might go and do mergers and acquisitions, but what the company is saying is that they are not going to do mergers and acquisitions. They are going to do collaborations, licensing from time to time, and that is where their strategy is. For example, very recently they announced a joint venture with Nestle India, another very powerful brand in India, and this is the direction that the company seems to be taking. The third point that I want to speak speak about is from a valuation perspective. Have a look at my screen and you will see in the last 5 years, the median PE has been around 24.3. Right now, the stock is trading well below the median PE. If I talk about the price to book ratio in the last 5 years has been around 4.1 median basis, and right now it is at around 3.9. Fourth point, if you look at the shareholding pattern, you will very quickly note that in the last quarter, there has been some buying by the DIIs already, while the FIs have reduced some stake because FIs has been net seller in the Indian stock market. But overall, if I see, the DIIs have started buying this particular. Moving on to stock number 3 from IT sector, a company called KPIT Technologies Limited. Many of you have been requesting to analyze KPIT Technologies Limited. So here we are analyzing KPIT Technologies Limited. Also, if you are new to my channel, consider subscribing and let me know in the comments any particular stock you would like me to analyze in upcoming videos. I would consider the stocks that have been most commented by you people, right? With that, have a look at my screen. You will see the last 5 years, the stock has grown at a 78% CAGR. Stock that was trading at around 97 rupees back in September 2019 has now gone to 1700 level. So a multi-bagger stock. What is driving this particular growth? Let me give you 2 to 3 minutes of commentary and you're going to learn a lot about this particular stock. In the last 16 consecutive quarters, the company has been growing like crazy. Have a look at my screen. You will see the revenues are up consistently, right? EBITDA has been growing up consistently. Biggies like TCS, Infosys, Wipro, in fact, have produced bad quarters here and there. Couple of quarters bad performance we have seen with Infosys, TCS, Wipros, etc. But this company has been consistently compounding in terms of the revenues as well as profits. And this is the point number 1 that you need to keep in mind. In fact, if you look at the latest results, Q1 25, the company produced around 25% growth, 24.8% growth on a year-on-year basis from a top line perspective, and a PAT growth of around 42% growth. Tell me which IT company that you know is growing at this sort of numbers? Very none. I mean, companies like TCS and Infosys, they are growing at single digit growth level. 5 to 6% is the maximum growth they are going at. Of course, they are at a bigger scale, I understand that, but still the growth here that we are seeing with KPIT Technologies is huge. Now in the last quarter, the company has done very strong wins. You can see the pipeline of $202 million worth of projects they have won. So looks like they are doing pretty well right now as far as new business is also concerned, and that is why precisely from a valuation perspective they are trading at a very high PE of 72. But if you look at the PEG ratio of this company, again 1.47, the lowest in their competitors or peers, because of the simple reason that even though their PE is very high, the EPS growth is also very, very high, bringing the overall PEG ratio very, very low. Now, another hypercritical point that you need to understand about this particular company, have a look at my screen and you will see that majority of their revenues are coming from Europe. 84 million US dollars are coming from Europe, and the US is not that high in terms of the contribution. And this is very different for this company versus many other IT companies, because the fears of recession in US is likely to play less in this particular company. And you will note that in the last few days, when the talks of US recession has been around, this company has not seen any significant correction at all, because of this reason that their main business is coming from Europe, and the growth has been very, very good in Europe, 24%, right? If you look at the Asia as well, the growth is coming from Asia, 59% growth is coming from Asia, right? So this company is insulated from US recession to a large degree. Point number 2 here, you will note that from a IT perspective, cloud-based connected services is where the maximum growth is coming. IT folks will understand that very, very easily. But the point I want to get to is point number 3 here, which is the passenger cars versus commercial vehicles. So people who don't know, this company is primarily into the auto sector only. Unlike many other IT companies that are working for banking clients, pharma clients, FMCG client, this company only works for the auto company. So it has created a niche for themselves. But if you talk about the auto sector here, passengers car, very, very good growth coming from that particular segment, 31% growth. But commercial vehicles, there is a degrowth here, and I have been warning people about Tata Motors as well. Just few days back, Tata Motors have fallen down. Why? Because of the fears around their commercial vehicle growth as well. Also, JLR business might be slowing down. It's a topic for another day, but the point I'm trying to drive home here is that commercial vehicle is where there is some risk that I can see right now in this particular company. Of course, the contribution is not very high, $27 million versus $132 million coming from passenger cars. The next key point is that the company is projecting to grow at somewhere between 18 to 20% of the guidance in the next few years, and this is the growth that we are expecting. Now, from a valuation perspective, the median PE of this company has been around 55. Right now, it is slightly overvalued, trading at a PE of 71. If I talk about the price to book ratio, median PB has been around 11 point now. It is now at 23.5. So yes, it is in my view slightly overvalued. Stocks like KPIT Technologies, although are good growth stocks, should be bought at dips, not at very high level in my view. But again, that's my perspective. You might have a very different perspective. From a shareholding perspective, in the last 1 quarter, there has been some buying already by the DIs, mutual funds mainly. And if I look at the FIs, they have cut some position in this particular stock. Overall, this is an excellent stock from a growth perspective. Of course, the risk of correction lies because the stock is touching all-time high. Buying at all-time high always comes with that risk, and that's what I want to be really honest with you. So in this video, I've talked about 3 stocks. None of these are recommendations. I've picked up these 3 stocks for analysis purpose. Let me know in the comments any other stocks you would like me to analyze. I might consider those to be included in the next upcoming videos. I hope you enjoyed the video. Check out the link for my YouTube community in the description or in the pinned comments. You are going to learn a lot. With that, I'll see you in my next video. Until then,